Seth Klarman's Margin of Safety, Risk-Averse Value Investing Strategies for the Thoughtful Investor is considered one of the most important texts in the world of value investing. Klarman, a renowned investor and founder of Bourpost Group, shares profound principles on how to approach investing with a safe and conservative approach. The book not only teaches about value investing but also emphasizes the role of asset protection throughout the investment process. Here are the important lessons that Klarman conveys in the book Margin of Safety. 1. The importance of margin of safety. The first and most important lesson in the book is the concept of margin of safety. Risk protection. Klarman explains that when you invest in a company, the stock price needs to be lower than the true value of the company by enough to minimize the risk of financial loss. Margin of safety helps protect investors from unpredictable market fluctuations. Choosing value stocks. To have a large margin of safety, investors need to find stocks that are being priced by the market lower than the actual value of the company, creating a cushion between the market price and the actual value. 2. Invest carefully and have a long-term strategy using the value method. Seth Klarman advises investors to avoid short-term investment strategies and focus on long-term value. Value investing strategy. Invest in companies with solid foundations and sustainable growth potential in the long term, unlike buying and selling stocks based on short-term market trends. The value method requires investors to carefully evaluate the actual value of the company and decide to invest only when the stock is undervalued. Be patient and long-term. A value investor must be willing to hold stocks for a long time, waiting until the true value of the company is recognized by the market. 3. Don't let emotions dominate your investment decisions. Klarman emphasizes that letting emotions dominate your investment will lead to wrong decisions. Investment discipline. Successful investing requires investors to have high discipline, avoiding being caught up in short-term investment fevers or irrational advice from the market. Control emotions. Maintaining a stable and decisive mentality is essential to be able to be patient and hold value investments for a long time. 4. Understand risk and don't underestimate it. Risk is an indispensable element in any investment strategy. Seth Klarman warns that not understanding risk is a big mistake. Assessing risk. Investors need to identify and understand the risk factors that may impact their investments, such as economic conditions, market changes, or the financial condition of the company. Protecting assets. Klarman emphasizes that investors should not underestimate these risk factors. Protecting assets in any situation should always be a top priority for a value investor. 5. The importance of finding opportunities in volatile markets. A strength of Klarman's strategy is the ability to find investment opportunities during times of market volatility. Market volatility creates opportunities when the market is in a state of panic or high volatility. Many stocks will be sold off, creating opportunities to buy quality stocks at low prices. Calm in the storm. Klarman advises investors to stay calm and use these times to look for value investing opportunities, rather than panic selling with the crowd. 6. Never invest in companies you don't understand. Another important principle of value investing that Klarman advises investors is to only invest in companies whose business model and future prospects you really understand. Understand the company. Investing in a company you don't understand creates great risk. Investors need to have a solid knowledge of the company's industry, the factors that affect its development, and its ability to generate sustainable profits. Ability to evaluate correctly. When you understand the company, you will easily evaluate factors such as the level of risk, profit potential, and the ability to maintain a competitive advantage over the long term. 7. Diversify appropriately. Klarman suggests that diversification is an important strategy, but that over-diversification should not be done, leading to a decrease in the ability to achieve high returns. Diversify appropriately. Although diversification can help reduce risk, Klarman advises investors to diversify only to a reasonable extent. That is, to invest only in stocks that you truly believe in and have a clear understanding of. Be selective. Choosing the right stocks with quality and potential will bring higher efficiency than investing in too many stocks that you do not understand enough. Conclusion. Seth Klarman's margin of safety provides an extremely effective value investing strategy with a long-term vision and maximum protection from risk. The lessons in this book give investors insight into applying a margin of safety, risk management, and patience in investing. By following these principles, investors will have the opportunity to build a solid portfolio and minimize the possibility of losses during periods of market volatility.